Welcome to the Kaiser Report. I'm Max Kaiser. Currencies are crashing. Markets are tumbling. Taper. No, don't taper. No, I mean print. Print more. No, wait. Maybe we should taper. No, maybe we should print. Print, taper. Maybe taper. Print, taper, taper, print, tape. Well, markets are down 2%, 4%. Oh, wait, maybe we should print more. No. You know, having this whole thing as a command and control economy doesn't seem to be working. Yeah, milk, we need milk. Bread, no, bread, yeah, bread. Hurricane, print, command and control, what the frick? Stacy Frick?
Max, it looks very difficult to do this command and control. It's very hard because as soon as you control one single thing, it's like, I guess, the theory of relativity. It all changes. You change everything and then you have to go control that. And then you have to tell this lie and more lies on top of fraud, to cover the fraud, more fraud. So it's a never-ending cycle of a whirlwind of chaos.
Yeah, the central bankers have invisible hand envy. In other words, the invisible hand, as described by Adam Smith, you don't need central bankers. Mm-hmm. You don't need tapering. You don't need printing as such. And it's a beautiful, it's kind of the Bitcoin of its day, you know, from 240 years ago or so. That was the Bitcoin of its time, the Enlightenment, with Adam Smith. But then central bankers got very envious of the fact that there was something so beautiful and perfect as the invisible hand. So they started to degrade it, and they come up with this new command and control central bank model that, of course, is an utter failure.
Well, that's interesting because, of course, Adam Smith looked at nature, and when he wrote Wealth of Nations, and you look at nature to devise a perfect balanced market, and because nature destroys anything that's weak or bad. So all of these enterprises that we've propped up, all these banks, they would have been destroyed ruthlessly. I mean, it's difficult to watch those nature documentaries where the lion eats the poor gazelle, but that's what's got to happen in this in the financial system.
Yeah, there's room for you know, mutations that evolve to become the new standard. That's part of what you should see in an economy. So here in the UK, the small to medium enterprises are not allowed to thrive because a bank like RBS finds them, guts them, strips them, sells off to pieces, and devours them because they're a predatory monopolist. They're not a free market capitalist.
Yeah, but nature would say that if you're just going to favor the lions on the Serengeti, if you're only going to allow the lions and you like those the best because they're the most ruthless, then like you still need the gazelles and all the other animals out there to be eaten. But I want to look at this first headline regarding, you know, basically what to do against all these command and controllers who have seemingly lost control. Learn from Booba and demand delivery for true price of gold. So this is from the FT. This is from a few days ago, but I wanted to bring it up now as we're to meet with the second half, talking with John Malden. And a year ago, the Bundesbank asked for 700 tons of gold back. You know that. Well, according to this piece, last month, Jens Weidmann, Bundesbank president, admitted that just 37 tons had arrived in Frankfurt. The original timescale to complete the transfer by 2020 was leisurely enough, but at this rate, it would take 20 years for a simple operation. Well, perhaps not so simple. While he awaits delivery, Herr Weidmann is welcome to come and look through the bars in Federal Reserve's vaults. But the question is, whose bars are they? And then the FT goes on to recount the armchair farmer fraud. This is a new phrase. And he says, you are told, look, this is your pig in the sty. It works until everyone wants physical delivery of their pig, which is why Booba's move last year caused such a stir. After all, nobody knows whether there are really 260 million ounces of gold in Fort Knox because the U.S. government won't let auditors inside. So that's the armchair farmer fraud.
Well, it just gets back to fractional banking. You know, fractional banking. Here you have fractional gold. The London Bullion Markets Association here in the UK, for every ounce of gold they supposedly have, they've sold 100. They don't even have a tenth, 1/100th of the gold that they say that they have. And the COMEX is probably going to default, and they're going to have to go to a cashed settlement on these contracts. People are going to, if they all went to get their gold at the COMEX or London Bullion Markets Association, they would have to declare an immediate force majeure and settle in cash because they don't have the gold. It's in Asia now. The gold is gone.
Exactly, because as we've been discussing, this command and control system is based on fiat having value. First, they had to get rid of gold and any gold standard, but in order to keep people believing in their fiat currency, they have to control what is the alleged supply and demand of gold. Now, the FT article then goes on to say the delivery problem for the Fed is a different breed of pig. The gold market is far more than exchanging paper money for precious metal. Indeed, the metal seems something of a sideshow. In June last year, the average volume of gold cleared in London hit 29 million ounces per day. The world's mines are producing 90 million ounces per year. The traded volume was many times the cleared volume.
Look, it's an open secret that if you want to make a quick buck in the hedge fund business, you can call up any of these money center banks and borrow, let's say, $10 or $20 billion and sell counterfeit gold contracts onto the market, and they do it all at the same time. There's 2 hours in the day when the banks around the world collude to sell counterfeit gold contracts into the market, and you see a 3 or 4% drop. That happens every single day at the exact same time. And as the Bundesbank, as a matter of fact, and other bankers in Germany are now complaining about this open manipulation because they realize that this is why they're not getting their physical gold anymore. It's because the market's been so destroyed by these crony capitalists that they will never see their gold.
And this goes on to, it's something so much bigger that most little minds just don't understand it. So he goes on to say, but one day the ties that bind this pixelated gold may break, with potentially catastrophic results. So if you fancy gold at today's depressed price, learn from Buba and demand delivery. Now, this is some, most people just go, oh, I want to make money. I want to double my, US dollar exchange rate. And here he's saying this is the whole thing is going to evaporate. As Sandeep Jaitley has always told us, there's going to be no price there will be no dollar price, there will be no euro price for gold. This is what Crash JP Morgan Buy Silver was about. Most people are like, oh, I want to make $100 on it, or I want to make $500 on it. You're going to make no dollars on it. You're going to have gold and silver at the end of the day. That's what will happen.
The only AAA rated credit at the foundation of the global banking system is gold bullion. And if you notice, all these sovereigns are being downgraded from AAA to AA, et cetera. There's very few AAA credits left. Those AAA credits in sovereign debt are the money, the credit, the collateral that is on the balance sheet that supports these enormous Ponzi schemes. Like Deutsche Bank is an enormous Ponzi scheme, so is HSBC, so is JP Morgan. At the base of these Ponzi schemes are a few ounces of gold that they've rehypothecated into an infinity, and so they've created this enormous hologram of fraud that encompasses the global economy. Now, the Bundesbank, who wanted their physical delivery of gold, thanks to the report we did a few years ago, which started the whole thing in motion, they suddenly realized that A, gold's totally manipulated, B, they're never going to get their gold back, and C, Deutsche Bank, which is their JP Morgan, is probably technically insolvent without a shadow of a doubt.
Now, that is something that was announced in one of these articles talking about the Bundesbank only getting 37 tons back. They did mention that it was that you and I went into the Bundesbank, in case you don't know this, March 18th, 2008. That weekend, Bear Stearns had collapsed, JP Morgan took over the bank. On the Sunday night, Bernanke slashed interest rates by 75 basis points on Sunday night. Monday morning at 9 a.m., we had a meeting at the Bundesbank. They were in chaos, absolute chaos. There were people running around everywhere. They fobbed us off onto some, executives that we were supposed to speak to the head of the gold market. And Axel Weber at the time, he actually specifically said nobody's allowed to meet with a gold market person. During our talks, we spent several hours with them. They showed us around. They mentioned, you asked, oh, aren't you happy with all this chaos that you have all this gold? Oh, no, we don't have the gold here. It's in New York, they said to you. Yeah,
they admitted really. And then the Gold Antitrust Action Committee, GATA, picked up on the story. And then Lars Scholl, who went into overdrive. And now that resulted in Germany asking for their gold back from New York and other places. And now, 4 or 5 years later, they're being told, you know what? Fat chance, sucker.
And another thing that's emerged recently is that Tim Geithner himself specifically threatened S&P when they threatened to downgrade the U.S. debt from AAA. And sure enough, they were investigated soon after. They did downgrade the U.S. So that's in response to those people who say the U.S. would never care about the price of gold. They don't care about that. But obviously they do, because it's command and control. They're trying to control. What are they trying to control? They're trying to control perception about their integrity and their ability to control things.
Right. They're trying to control their sovereign bond price and believe that they're worth 100 cents on the dollar. And because if that's not true, then price of gold should be at $6,000, $7,000 an ounce. And that's where we're going as it becomes apparent that they're lying about their balance sheets at Deutsche Bank and HSBC and JP Morgan. They don't have anywhere near the collateral they say they have. They don't have anywhere near the assets they say they have. Neither does the Federal Reserve Bank, the ECB, or the Bank of England. They're insolvent, as in bankrupt, as in goose egg, as in there's nothing there but belly button lint.
Now, regarding all of these lies, on top of lies to cover up frauds, people have been controlled. Their perception has been controlled and distorted into thinking that it is all about finance. And because of that, we do have this pixelated wealth where gold can evaporate and the wealth of a nation can evaporate. And on this final headline here, why central bankers are completely wrong about inflation and how one country is trying something new. This is one guy's opinion on Forex Live, and he's saying that they keep on targeting CPI and the price of goods. And yet, not only are those prices rising because of all the quantitative easing, he points out, and 0% interest rates and free money and endless loans to the likes on Wall Street, well, wages are not rising. They're in fact declining. They're down almost 10% since the collapse began. And nobody's doing that, targeting the wages and the fact that people are earning less and less, and yet they're being more and more is being sold to them, especially via China, where they have infinite ability to create endless amounts of products, but nobody has the income to actually buy anything.
Well, this is really the genius of the global bankers, is that they figured out a way to inflate the value of the assets that they own without touching wages. 20 or 30 years ago, inflation meant that wages and prices went up simultaneously, and it caused an inflationary cycle. But then through to financial engineering, due to derivatives that came on board really online in the 1980s, there was a splitting of risk and reward, the same way Einstein risked energy and matter. The modern, options volatility formula effectively separates risk from reward and creates a nuclear bomb of financial engineering that kept wages from growing, but asset prices for a few people to go up. We got to go. We'll have to continue this next time. Thank you.
You're command and controlling this ending.
All right, stay tuned for the second half. A whole lot more. Welcome back to the Kaiser Report. I'm Max Kaiser. Time now to turn to John Malden, author of this new book, a new book called Code Red: How to Protect Your Savings from the Coming Crisis. John, welcome to the Kaiser Report.
Max, it's always good to be with you.
All right, now, John, this book, Code Red, there's one chapter in the book that makes it a must-read for anybody who wants to know what the frick is going on, because you talk about why interest rates should be raised. They should be raised as a way to get this economic policy back on track. So talk about that.
Well, it has to do with the natural level of interest, and it was something that was actually talked about by a Swedish economist way last century called Wixell. And the concept here is that there is a natural of interest. We don't know what the natural rate of interest, the market knows that, but when you set rates below the natural rate of interest, when the central bank does that, and that keeps savers from being able to make the amount of money they should have. But what that tells to investors and bankers and businessmen is that financial transactions make more sense than capital transactions, because the interest rate is one part of the information that we as businessmen send to each other. And we don't really think of it that way, but that's what it is. So when it makes more sense for me as a businessman to buy my stock, okay, to go out and do stock buybacks, rather than buying a piece of gear or equipment to compete with somebody else to try to produce more stuff to lower the price of something else, which was good for consumers because we get lower prices, and that's the natural order of things.
Okay, let me jump in here. Let me jump in here for a second because you're opening up a couple of different things, and I want to unpack this a little bit because I think it's very.
Yeah, it gets complicated. I agree.
Yeah, let me jump in though because, for example, Janet Yellen, who's coming in as new Fed chair, and other, including Mark Carney, who runs the Bank of England, they keep talking about the risk of deflation. And they keep talking about we need to lower interest rates to justify that because they perceive this risk of deflation. But what we've discovered, whether it's quantitative easing or zero interest rate policies, it's just there to bail out these zombie banks. If they were interested in creating inflation, in creating capital investment, in restoring the economy, they would raise rates. They would do the absolute opposite, correct?
Well, what they would do is allow rates to go to their natural level, and that 12 people in the case of the U.S., and I'm not certain how many they're sitting out in London or the ECB. I think there's 27 at the ECB. People wouldn't sit around in a room saying, we think we know more than the markets. We think we understand what rates should be. And what they're really trying to do is to encourage consumers to borrow money. They're trying to encourage businesses to borrow money and therefore consume more to buy more. It's driven by the Keynesian theory that consumption drives the economy. Now, I happen to think that it's not that we don't have enough consumption, it's that we don't have enough income. There's a complete difference in your approach. I think we need to make rates and allow things to work so that we can figure out how to produce the most income. And when we get out of the way of businesses and entrepreneurs, when we allow them to do what it is they do, and produce income, they can hire more workers, they can do more jobs, they can buy more stuff, and the world's transition smoother. Max, we had a problem this last crisis that was caused by too much debt and leverage, and now they're trying to encourage more debt and leverage. The problem is it's like, going to your brother-in-law, he's flat on his back drunk and say, oh man, you're too drunk, I know how to cure that, here's another pint of whiskey. That's just not the cure.
Yeah, I understand, John. That's all. The point is well made. I'm just saying that in the use of language here, the use of the word deflation is completely misused. And whenever they talk about we could perceive deflation to be the risk, then we're going to justify lower interest rates. They're going to do what you're saying. You're promoting consumption over investment. You're promoting debt over equity. You're promoting currency wars over a kind of a manufacturing base. But I want to move on and talk about gold for a second.
By the way, there's two types of deflation. There's the deflation that you and I like. That's when the price of our hamburger goes down, when the price of our eggs or our cars or our telephones go down. That's good. Nobody gripes about that. What they don't want to see as deflation is when your stocks go down, when your houses go down, and so forth.
So in other words, there's two definitions of deflation, of course. One is a good deflation where the price of electronic goods are going down because of global competition. So you're paying less for electronic stuff. Then the other type of deflation is bond prices or bonds that are held on the books of banks, zombie banks, that if they were to actually let interest rates rise to their natural level, those banks would be immediately insolvent and those people would be out of work. So here you have a situation where they don't want natural interest rates, which would promote savings and get rid of the zombie banks, but they don't really make any room for competition of the deflation that you would normally associate with firms competing with each other unless you see outsourcing of labor to China, et cetera. Meanwhile, on the inflation side, they love the inflation that comes with inflating away debt, but they hate any inflation as it relates to wages. So there's no inflation in wages, but there's inflation in asset prices. How did that happen, John? if I'm not building too much into this question.
There's several things that we can look at as to why there's been no growth of income. Part of the problem is that in the globalization process, individuals are competing on their wages and price. People who have a skill, and that skill and talent there's not a lot of it. They've actually seen quite big rise in their income. People whose skill, that there's abundance of that skill. And I'm using something because my kids do it and I do it. If you're a waiter, there's a lot of people who can be waiters out there. So waiters really haven't seen a rise in their income. So it's a tricky subject when we say we haven't seen a rise in income. We haven't seen an increase in income in general in the U.S. or the U.K. now for some time.
Right. Okay. Let's move on to gold for a moment, because you write a lot about gold, and it was down by more than 30% last year. This time last year. Now, on days when gold is down, the mainstream press will say this is proof that the central bank money printing policies are working. Your thoughts?
I just, when somebody says that, I just kind of sit back and go, really? So when gold is up, that means they're not working. The central banks in general don't like gold because it's a check on their actions and their what they're doing. But gold has a mind of its own. It ran a little too far. It's had a normal correction. What will happen is we're going to see inflation turn back up because of all the money printing they've done when the velocity of money turns up. And I don't know when that's going to happen. Nobody does. It's something that happens in decades-long cycle. The middle of the last decade, it started turning down. That's what has allowed central banks to print more money than anybody would have thought. When it turns back up, they're going to have to take that money off the table, or we're going to see inflation. And at that point, we could see gold skyrocket. By the way, we could see gold move sometime here in the near future due to a completely different phenomenon. It has nothing to do with money printing. It's that we have created too many derivative gold products. And there's not enough physical gold to deliver all those products. In fact, there's only about 1 ounce for every contract out there. So if everybody wanted to decide, and if it won't happen, everybody won't. But more and more people are deciding, I want my physical gold, I don't want my contract. And that move to physical gold is decreasing the amount of gold available for physical gold. And when that gold gets down to where it's not available enough for physical delivery, spot gold is just going to go through the ceiling.
All right, John, you're a world traveler. You've got one of the most, or if not the most, widely read financial newsletter in the world with, I think, 1 million subscribers. You've got this new book, Code Red, How to Protect Your Savings from the Coming Crisis. You were just talking about gold and the fact that people are demanding physical gold, and they're at risk of not getting it because there's 100-to-1 leverage, or the 101 paper claims to actual gold. What about Germany? Now, you're a world traveler, as I mentioned. They asked for their gold back a couple of years ago. They were told basically they can get it back in 20 years. They got back very little. Now they have an investigation into the manipulation of gold. They want their physical gold. What's going to happen in this case? Are they going to press the issue? Are they ever going to see their gold? And has their gold been sold, as some suggest, by the central banks as part of this global effort to keep the price of gold cheap? Your thoughts?
We don't know. That's why there's an investigation, Max. I mean, that's a curiosity. If I were the Germans and I wanted my gold, I would be doing an investigation myself. Okay, well, this is a setup. Okay, let me move on, because my final question, we've got about a minute left, is you're talking about we're in the early stages of a currency war. Certainly gold would play a role in that, I would think. So we've got about a minute, so just lay out your case for this. We're in the early stages of the currency war. Where do you see that going, John Malden? The first real missile was fired by Japan, and they're going to continue to launch. The yen is up from 78 to 104. It's going to go to 110, then 120, then 150, then 200. Because of things we lay out in the books, it's 2 full chapters. Japan has to cut the value of their currency in half over time. That means the rest of Asia is going to have to respond. Europe's going to respond. Germany is Japan's biggest product competitor, not Korea, not China, not the United States. Germany's got to figure out how to take the euro down, which means that it's going to have to create all sorts of situations going on in Europe. The Bank of England has decided that it wants to take its currency down. We're going to see currency manipulation on a scale that we haven't seen since the 70s or the 30s. And that's a completely different type of market than most of us are used to. Gold during that time period, gold is a neutral currency, and I would expect gold will go up against most currencies.
All right, John Malden, I'm going to have to leave it there. The book is called Code Red. I've read it. It's a must-read. As the title suggests, how to protect yourself in the coming currency wars. Thanks so much for being on the Kaiser Report.
Max, thank you a whole lot, and let's do it again.
All right, fair enough. And that's going to do it for this edition of the Kaiser Report with me, Max Kaiser, and Stacey Herbert. I'd like to thank our guest, John Malden, author of the new book, Code Red. If you'd like to get in touch, tweet us at Kaiser Report. Until next time, bye, y'all.